We are joined by Mayank Bansal. He's the president of UAE-based hedge fund and also the whistleblower. Thank you so much for taking time out for this very exclusive chat with ET Now. I have a lot of questions to ask you with all the data that you have submitted as a whistleblower. But then, Mayank, let me just start with this. Now, you've mentioned that a margin of just 750 crores can move Nifty by 2% on expiry day. My question to you is, can you please walk us through the mechanics of how this is achieved and a slight comparison, if you could give us, on capital dynamics in other international markets? You know, how did you arrive to this particular number?
Firstly, I would like to clarify that I am not a whistleblower who's internal to Jane Street. So I have at no point worked with Jane Street.
Sure.
But yes, in the industry, I have sort of raised it. But at no point have I, at my end, worked with Jane Street. Regarding moving Nifty, so if you see the net FII and DI numbers, right, which are published on a daily basis for both NSE and BSE, you will see that the net, and these are the two key segments in Indian markets, the FII segment and the DII segment. You will see that the summation of these numbers, I'm talking about the net number, which is buy minus sell, the net number. They would buy a lot, they would sell a lot, but the net number is simply to the tune of 3,000 to 4,000 crores on a daily basis. This can be validated by your viewers by simply going on the NSE website and seeing the FII plus DI numbers. Now, whatever moves that come in the market come as an outcome of this net 3,000-4,000 crores that is there. Okay, so if you pump in similarly 6,000-7,000 crores, right, to move the market, if you just buy Nifty or Bank Nifty, for example, in the SEBI order, it's now apparent that even in Bank Nifty, the manipulating entity had simply used, cash and futures to the tune of 5,000 crores. So if you take this kind of exposure, which is to the tune of 5,000-6,000 crores, you are in a position to move the Nifty. Now, what happens is that to take 6,000 crores of exposure, you don't really need 6,000 crores of capital. That is where futures come in. Futures allow you to take that exposure with practically 1/6 of the capital outlay. So for a 5,000 crore, with 15-20% of the capital outlay, you can take the required exposure. So for a 6,000 crore exposure that needs to be taken in Nifty, all you need is 1,000 crores of capital to use futures to move it. So that is how this figure of 750 to 1,000 crores has come about. And it's been validated by the SEBI order for the Bank Nifty 17th Jan expiry, wherein this is precisely the amount that has been used to move Bank Nifty. So that is the origin of this number.
All right, Mayank, hi, Ankur this side. I'm more curious to ask you, you mentioned about this kind of details which you have analyzed. When was the first time you actually reported to SEBI? The timeline which has been given by SEBI that it all started in 2024, where they noticed an article. Where did you come in picture and informed the details about this matter?
And I'll just add one more line to your question, because I'm also curious, Mayank, to know the specific evidence, or market data that you presented. I think we're talking about December 2024 timeline.
Yes,
sure.
Precisely.
Yeah.
So, see, even manipulation has been going on since July 2023. It did not start in 2024. It started in July 2023. The extent of manipulation used to be low then. It used to be slightly low. It kept increasing. From July 2023 all the way up to DEC 2024, the magnitude of manipulation just kept increasing. I reached out to SEBI I mailed SEBI, regarding this issue after having witnessed and been convinced about it in January of 2024 itself. So I would say among the most seasoned participants, they were convinced about manipulation happening by January 2024 itself. They were just sort of waiting for the regulator to correct this and for this to somehow get auto-corrected. Either the manipulator leaves on his own or some action is taken. They were waiting for that to happen. But what instead was happening was that things were moving in the opposite direction, wherein the extent of manipulation from January 2024 all the way to DEC 2024 only kept increasing. At this point, it was pertinent that this, be brought a stop to, which is when I reached out to SEBI. On 17th DEC 2024, I had mailed SEBI a pretty detailed mail with an elaborate presentation regarding different market patterns which were manipulative in nature. I mailed SEBI that, and I would really like to commend the swiftness with which SEBI acted post my complaint. So Anant Narayan who's the whole-time member, who's in fact written the order for this, messaged me the very next day. So it's kudos to SEBI for having acted on this, on being reported at least very swiftly. And subsequently, I gave a presentation in SEBI Bhavan at BKC, where Anant Narayan was present, the surveillance team was present, the market regulation department was present. There I made a detailed in-person presentation. Since then, I've been engaging with SEBI on mail. We have some conversations ongoing. I report to them whenever I see market anomalies, and yeah, this is the broad timeline.
To SEBI, Mayank, I absolutely second the thought, and I take it from there. There are many questions actually, and one such as how fair is the comparison between losses in weekly versus monthly expiries. But at the same time, when you talk about all of these, yes, the exchanges are watchful, and it is very important to be watchful in scenarios like this. With 91% retail traders posting net losses in FY25 despite reforms, what do you think should the investors also do? Of course, the exchanges are mindful and watchful and doing their bit, but at the same time, is it the lack of investor awareness also which is leading to the scenarios like this, and what next should be done from that end?
Investor awareness, I think SEBI is strongly trying to push now. Maybe it was lacking 1.5 years back, but now at least SEBI's, wherever you log in, you see 93% of the retail traders are losing money. That comes as a cautionary note before you log in even into a retail banking site. So SEBI is trying to raise investor awareness at its end. But I think the retailers also need to take cognizance at their own end that, I think they've got addicted. It's like a ready available casino at their home 24, at least during the market hours. And just because I think they started participating in it during COVID times when a lot of people were working from home, that addiction has sort of developed, and despite facing losses, despite when they see their financial statement, I'm sure they realize that they've suffered losses. In spite of that, they are continuing to sort of trade options on Indian indices, and they should not do it. Like, I would really advise via this medium to and tell retailers that you shouldn't do it. Like, there are people who are far greater experts in this field than you are, and it is likely that you will lose money.
Sure.
It's obviously the extent of 91% is very high, also due to there being a manipulating entity which was sort of creating patterns that would induce participation, and retailers would get trapped as a result. So that is there. It's mentioned in the SEBI report also that one of the reasons possibly why this number could be as high as it is could be that there was a manipulating entity at play. Having said that, even if it were not at play, still most retailers would lose money. And in general, I think retailers need to sort of rein themselves in from trading this, knowing, having confidence in the knowledge that their knowledge is limited.
Sure. Word of caution from your end, and definitely need of the hour. But then I'll just take you back on your report that you also presented to the regulator. A few technical aspects. Now, since you've been explaining all of this in very simple layman language, it's beneficial for our viewers and also safeguarding them, Mayank. So going ahead in that, regarding implied volatility, you flagged out that IVs move up before the move came. So I want to understand to what extent does this reflect a pattern versus outright puppet master manipulation? I'm just clubbing few questions. You can answer all of them, okay? Other question is, expiry volatility appears to be the key player as per your scrutiny. Now, how did Jane Street strategies evolve from targeting less liquid mid-caps to the heavily watched Bank Nifty and Nifty 50? And third question, this was actually Ankur wanting to point out, and you can ask Ankur.
No, I just wanted to know whether it is just Jane Street or there can be other entities, because you were not entity specific. You are saying that market manipulation is at play.
So see, that is the basis for seeing that all these manipulative patterns are playing out. What is happening is options have a parameter called implied volatility, which is a measure of how cheap or expensive options are. What used to happen is that there are two kinds of expiries, which I'm sure your research has sort of revealed to you, but I'll just lay it out for the audience. There are two kinds of expiries. One is a quiet expiry and one is a volatile expiry. In quiet expiries, what you would see is that IVs would, absolutely plummet. They would fall through the floor. And it would be bizarre. It's like, I have given an example at other places that it's like a real estate property which often sells for, in 2-3 crores or whatever, selling for maybe 2-3 lakhs. It becomes obscenely cheap on quiet expiries. IVs becoming cheap means that options are very, very cheap. They are being priced very cheaply, and market participants, like a lot of prop desks, like myself included, would keep wondering as to why someone would potentially be selling options at such low prices. Now, when you sell options, okay, the money is meant to be made when the market stays extremely quiet, because then you pocket all the premium of the sold options. So what the manipulating entity on quiet expiries, what they would do is that they would sell options heavily and then maintain the index in an enormously tight range. There could be the India-Pakistan war going on. There could be US-China trade war going on. There could be any news flow, but they would not let the index budge. It would be in a very, very tight and constrained range from where it would not be allowed to move, so that all the options that they've sold, they pocket the entire premium of all those options. This was the first construct. It is very odd for IVs for implied volatilities to become this cheap, as in the example which I gave. A real estate does not ever sell for 2-3 lakh rupees. Now, in case you, as someone who's seen the real estate, saw it at 2-3 lakh rupees and ended up buying it, then you would suffer a heavy loss instead, because the manipulator will take it to zero. So that was the quiet expiry. The second expiry was a volatile expiry, the second construct. In a volatile expiry, what happens is that through the morning hours, by the way, in response, I'm answering question number 1, but in response to partly question number 2 also.
Yeah.
Right.
All this manipulation is focused on expiry days. This is an expiry day phenomena, by and large. There have been,
Totally.
here and there instances of this happening on non-expiry days also, but by and large, it is an expiry day phenomena.
Correct.
Okay. So on expiry days in the second construct, which is the volatile expiry construct, he would pick a side, it could be the downside or the upside. And then he would buy options in absolute bulk. He would buy, let's say he's picked the upside hypothetically. It's up to him. It's up to his, whims and fancies. Let's say he's picked the upside. Now,
Yes,
in the
ma'am.
morning hours, when the market opens at 9:15, he will buy calls, at the money calls, out of the money calls, deep out of the money calls, deeper OTM calls. He'll buy the entire chain of calls.
Yes.
Okay, he'll keep building.
That's right.
This is evident in IVs shooting through the roof. Okay, it's like I've given this example. It's like a handkerchief selling for 1 lakh rupees. Okay, so your market participants are like, what is going on? Like, this is absolutely obscene and bizarre. Okay, so they would basically shoot through the roof, IVs. People would be left scratching their heads as to what is going on.
Mayank?
And then the answer they would get in the last 2.5 hours post 1 o'clock, when there would be a steep up move that would be delivered by the manipulating entity that would end all these calls in the money
Yes.
at settlement.
We agree.
He would end all of those heavily profitable. This is a pattern which is repeated on practically all indices. It's not Bank Nifty, something that has that only has been picked up by SEBI, but it's
Okay.
actually been repeating on all mid caps like Fin Nifty, Bank Nifty, Nifty, Sensex, all indices.
Mayank?
So
That's right. We actually bombarded you with questions, but this one was very much required. And the deep dive analysis which you have done, yes, this is an investor awareness topic in itself, and the addiction is big, and that's the reason. Like I said, it's a burning hand-like situation which the participants are really getting trapped in. Thank you so much for that, Mayank.